I think there's a very simple relationship that's going on here, Kai, and let me do a couple of steps through it. So the first thing is to go back to that idea of hyper financialization. If equity prices in particular lead the real economy, the equity market has been robust. If you look at the correlations between the equity market and the employment market, jobs, very, very high. If you look at the correlation between the employment market in broad terms and what we refer to as nominal GDP, so inflation plus real growth, they're very, very high. So what does this basically mean? I think this means the longer that equities continue to remain robust and rally, the more robust the labor market remains, because CEOs don't feel the pressure to lay people off.
Welcome back to Soar Financially, everybody. Always appreciate you joining us. We have a great conversation lined up today. I'm really, really looking forward to it. We had to move it a couple times due to my schedule because I was traveling, but it's a conversation I've been looking forward to for a while, actually, because there's lots to talk about. And let me throw a couple facts in your face before we get started. A, the S&P 500 just closed a fifth straight month up in the green. It's a long streak. And the Fed last week said that, well, their staff is predicting no recession coming out of whatever we're in, to be honest. So that is another puzzling statement. So how does that all fit together? Maybe I got off or got out of bed with the wrong foot today, but I feel fairly critical today because just looking and preparing for this conversation, I warned my guest beforehand. I was like, maybe the Fed was right after all. And they outsmarted all of us, all the mainstream media commentators, all my guests here on the program that called for a recession and just a lot of market turmoil, and it's just not happening. Now, that was a long introduction. Before I switch over to my guest, subscribe to the channel. Right there, it says subscribe on it. But let me introduce Julian Brigden. Really excited to have him on. He's the founder of Macro Intelligence 2 Partners. They're a research and analytical firm based in Denver, Colorado. Really, really looking forward to having him on. Been looking forward to this. Julian, thank you so much.
Pleasure, Kai. Thank you very much for having me on the show.
Absolutely. Yeah, I think it's going to be a long one today. We got lots to discuss. We briefly chatted just before hitting the record button because there is lots to discuss. And I'm not even sure where to start. I'm looking at all the buzzwords I wrote down over here, and I think we should start with a recession debate, to be quite honest. And I said it in the intro. Has the Fed outsmarted all of us, Julian? Is there really going to be a no landing?
So I've spent sort of 30 years following the Fed, and I've a number of friends who spent even longer. You know, I've got a friend who worked for the Fed in his early career, went on to be Senate chief economist, and his favorite comment is, "I've followed the Fed man and boy for over 45 years. They're always the most bullish at the top, and they've never caught a turn." So I'm going to stick with that, Kai. And I think we've got to understand, you know, the Feds are very, and central banks in general, you know, we like to think of them as independent, but they're highly politicized institutions. I mean, you can obviously, you know, as German, you can see it with what's happened to the ECB since they were basically founded. I mean, it's not the Bundesbank, right? It is definitively not the Bundesbank. They have an additional political policy objective, and that's basically to hold the Eurozone together. You know, and the same is true of the Fed, right? I mean, this is a Fed, you know, by virtue of their mandate, which is both employment and inflation, they have to tread very, very carefully. So when you've seen them talk about, you know, sensitive things like employment, their approach is very covered. They're not very direct, right? They will say we are going to get inflation below 2%. But when they talk about the employment market and how that traditionally would occur, which would be via a recession, they talk about balancing supply and demand. So in the labor market. So I do not believe that the Fed has necessarily nailed this one. And I think, and in fairness to the Fed, I think we need to add another condition to that. I don't know whether the market's read of the Fed is correct. So, you know, the Fed has tried desperately, Kai, to talk about higher for longer, right? This rate cycle will necessitate that we hold rates much longer at these sorts of levels, right? And that's a very marked departure and from what is priced in the market, and also from what we typically see in a tightening cycle. Typically, what the Fed does is they march rates all the way up, and then they break something, and then they march them all the way down. And the intention in this cycle was not to really do that. And if you want to get a little dweeby and technical, the difference is we're following what they refer to as an opportunistic policy cycle. And it's quite different, an opportunistic disinflationary policy cycle. And it's quite different from a deliberate disinflationary policy cycle. So if you go back in history and you think of what Paul Volcker did, that was deliberately disinflationary. So he literally destroyed the economy in order to create deflation, a deliberate act. This is an opportunistic approach. So what does that mean? It means that you raise rates up to the point that they're painful, right? They don't kill the economy, they're painful. And then you trade off the level of rates for the time that rates stay on hold. Okay, so you could be holding them here for years. In fact, the only other time that we've pursued this policy was under Alan Greenspan in the mid-90s. And he basically kept rates unchanged for 4 years, 4.5 years, to lower CPI by 2%. The problem is, Kai, to go back to this contradiction between what the Fed is trying to purvey and what the market has priced, the market doesn't see this, right? The bond market has massive rate cuts priced in. And this is clearly at odds. And the Fed has tried to explain this in fairness to them, but they haven't. So I sit here and I say, look, if indeed, and we can debate this, the economy is actually showing signs of re-accelerating, then certainly the idea of rate cuts, given that we're in this opportunistic disinflationary policy environment, is wrong. It's just out and out wrong. And in fact, we may get further rate hikes. And we wrote a piece to our clients yesterday saying, you know, the Fed may have easily another 100 basis points to go, potentially, depending on how kind of things pan out. So I think we've been saying to our clients, tons and tons and tons, and I think this is possibly why you're critical, contradictions in this market at present, right? S&P at new highs, Goldilocks, you know, we've got no inflation, renewed growth, the Fed's done, they're going to be cutting rates, a bond market's pricing that, and a Fed, I don't think, that's in any situation whatsoever to actually deliver that. They're either, best case scenario, rates are not going to get cut. Worst case scenario, they're going up. And a small scenario that if suddenly tomorrow morning we woke up and the equity market had imploded, sure, you can get your rate cuts, but it sure as shit doesn't look like we're going to get an equity market that's imploding.
No, lots to touch on. Fantastic introduction to our conversation here, Julian. I made a lot of notes actually while we were chatting, and one of the main questions I wrote down and underlined it twice is it painful yet?
So I think, look, yes, there are certain sectors of the economy which are clearly feeling pain, but there are some quite unique elements in the United States which, you know, particularly the availability of long-term fixed financing, which has enabled people to avoid pain thus far, Kai. Right, so we really do, whether it's on the consumer side or even on the corporate side, have a world of kind of haves and haves not, right? So who are the haves on the corporate side? Well, they're the big S&P companies and mostly the big tech companies, because these guys are sitting on cash, right? They are cash rich. They have some borrowings, but it's really for tax reasons and funding reasons and so on and so forth. But they are long cash. Well, they're earning 5% on their cash, right? Their stocks up. What pain do they feel, right? None. Perversely, if you're, you know, a commercial real estate developer or even potentially, you know, a small business trying to fund yourself, right? Suddenly your funding rates are 8 or 9%. And you don't have cash, right? And we can see it, you know, people are getting squeezed, right? We just saw the trucking company Yellow go bust the other day. You know, we're finally starting to see to deal with these zombie companies, but it takes time because even the worst names have got some termed out funding structures which run through to next year and the year after, right? So that's why one reason why the Fed may have to hold rates at these levels for much, much longer. If you look at the consumer, likewise, we have this haves and haves not, right? So you have, if you're wealthy and you have a fixed rate mortgage, what's the Fed done to me? My stocks are up, my house price is up, I'm still paying the mortgage rate. Who cares? But if I'm a millennial trying to find a house, trying to fund a new car purchase, all of those things are much more painful. So there is this is why I think, Kai, we get to this point that, oh, it isn't working, right? It isn't working. And yet when you look underneath the covers, there should be some things which, and there are definitely signs that are recessionary. You mentioned Germany being in recession. Why is Germany in recession? Because it's a super highly leveraged manufacturing economy. What did we do during COVID? We massively over-ordered. We have a huge inventory overhang in the manufacturing sector. The consumer is okay, but he's suffering a little bit from higher prices. He's not able to buy as many units of production because the price has gone up. Put that together with high inventories, and you get an inventory cycle, which is quite ugly for manufacturing. Okay, you have the same thing here in the United States. So I mean, ISM came out, manufacturing came out this morning. It was a little better than expected, but it's sub 50. It's in contractionary territory. We have a manufacturing recession globally. Okay, in the US, we also have tightening funding. We saw that from the senior loan officers survey again last night. Credit conditions are tightening. And thirdly, I think we have signs of peaking in terms of construction activity. It's not horrible, but I just don't think we're going to keep building as many homes or as many buildings, particularly multifamily and office space, right? So that will weigh, all of those things will weigh on growth. Offsetting that, you still have fiscal spending, which is keeping things ticking over. And you also have a very robust equity market still. And that equity market, we have this term that we call hyperfinancialization. And hyperfinancialization is a process whereby if I asked you logically, which comes first, which is the chicken, which is the egg? Is it the real economy that drives financial markets, or is it financial markets that drive the real economy? Logic would sort of dictate that it's the real economy. The real economy comes first. It sets inflation levels, it sets profit levels, it sets employment levels, and all of those should dictate what happens in financial markets. Not in the US. Statistically, what actually drives everything really is the equity market and this robustness, that because it dictates what CEOs do, right? Remember, they're only paid to be shepherds of an equity price, and as long as their equity price is going up, everything's fine. As soon as the equity price goes down, they start laying people off, all the things sort of go wrong, and we drive the economy into recession. So this bounce that we've had in the first half of the year in the equity market is now feeding through into things like sentiment, right? ISM data was not great, but it's better than last month. And it's, if you look at the lead lags, that should be dictating. And so all of these things are kind of, you've got this waxing and waning here, Kai. And that's why I said, you could correct, we would be instantaneously in a recession if you get a correction in the equity market. But as long as this equity market stays here, there is a risk that actually we work off the inventory cycle, right? We start to get new orders coming in. And if that's the case, then that would take the manufacturing risk out of the economy. We could get, you know, still, you know, if equities stay up, people can afford houses. Maybe we get, maybe the construction slowdown isn't as bad. And maybe they can choose not to borrow money from the banks, but they can borrow money from private equity, right? Because the equity market stays robust. And so you get that one as well. So there is this, I think there's we're at this interesting point where something kind of has to give, where equities have to go down, or as we've seen time and time again in this whole cycle, the bond market is going to have to push rates higher to try and tighten financial conditions to deliver this slowdown.
Again, so many things to touch on, really.
Yeah.
Like Julian, fantastic commentary there. I wrote down a question I want to ask you is like, why hasn't the housing market rolled over? I looked at the 15-year mortgage rate; it's over 6%. That's an insanely high number. I personally refinanced my house recently just for 0.9. Okay, just
Nice.
imagining 6% or having to pay 6%, I wouldn't be paying anything back. It'd be all going to interest more or less, and that's it. Right. Why hasn't that happened? And consumer confidence is the highest since October 2021. You mentioned that. You touched on that. So, like, how does that fit together? Like, why are people? Is there a dichotomy? Like, it feels like the market or even consumer confidence is split going both ways. Like, there's let's call it the blue collar and the white collar, for lack of a better term. Confidence, right? You said people are investing in the stock market. That's usually let's call them the higher income, category. It's not the lower income. The day laborers don't usually have stock portfolios, right? So
no, absolutely not.
How does that fit together?
So I think, look, let's take the first one. So in the US, if you look at the housing market, even in Europe, right? I mean, we're still showing a lot of resilience. House prices are coming down in continental Europe, particularly, obviously, we've seen in somewhere like Sweden, they're coming down very sharply. Germany, got as overvalued as Sweden did. I think that comes down, Holland, Denmark, same sort of thing. So the Northern European situation, I think you do see it working there. Obviously, you have a very different structure to your mortgage market, or in many countries, you have a very different structure to your mortgage market than you do, say, in the United States. I think in the United States, part of the problem is this lack of building. We aren't seeing a big burst, and we haven't seen a big burst in houses under construction. I think, part of that is because the cost of those houses is very unaffordable. I think that's just going to keep things quite tight. It doesn't mean, I think the biggest stress you're going to see is things like multifamily. So I do think overall level of construction activity drops. But, I've already got models that are showing, because we're not building more houses, house prices could actually start to re-accelerate again. I mean, I think we're in this kind of stasis, Kai, where, you're really not going to be able to have too much acceleration in this space, but it may not fall. So I think,
Julian, can I intersect here just real quick? Because I want to throw in the comment of variable mortgage rates here as well. Because a lot of in the US, we don't really have that here in Europe, is variable mortgage rates, right? Where people finance for 2-3 years. And now we're a year and a half into the rate hike cycle. People will slowly have to start refinancing the mortgages.
Correct.
So how does that factor in as well? So if you could take,
look, that's definitely a factor within Europe, right? I think that's why you're starting to see that. I mean, Sweden doesn't have any fixed rate. That's why that's where their house prices are adjusting instantly, right? Because it's all an affordability equation, right? How much do I earn? How much does the house price cost? Exactly. How much does it cost me to finance that? If the financing goes up and I don't earn more, the price has to come down. And that's pretty simple, and that's what's happening. In the US, it's happening more slowly because you have fixed rates mortgages. You also have certainly in the new home building space, you've had builders willing to buy. And I do think it goes back to this higher for longer argument. There are a lot of people, and I have friends who've done this, who have bought houses at 6%, 7%. But they've all said, but 2 years from now, I'm going to be able to refi at 4 or 3, right? Because rates are just going to fall, right? And I know that's happened in the commercial real estate market. Like, people are borrowing money for 1 to 2 years at very high rates, but it's to keep deals alive. And their assumption is, there's an American expression in American football where at the end of the game, you've got like seconds to play. There's one of your guys at the end of the field and you throw the ball, and it's called a Hail Mary pass. Yeah. And I think there's a lot of people doing that, right? Everyone is assuming that rates have to come down. I think it's a reasonable bet. I'm not sure it's right. And I think because of this, and because, as I said, you know, this is delaying some of the correction. It's another reason why I fear the Fed may have to keep rates much higher for much longer than people envisage, and possibly the same true of the ECB.
Comes back to my comment that we're trying to outsmart the Fed. People
Correct.
throwing
We're
those
always trying to,
right?
yeah, we're always trying to outsmart the Fed. And I think, you know, the other thing, to go back to your other question about consumer confidence, why hasn't consumer confidence deteriorated materially? Well, because you can model consumer confidence reasonably well on the equity market in the US, certainly Michigan, on the equity market, and also and the equity market one encompasses house prices and a few other things, because the correlation is pretty much 1-for-1. And gasoline prices. And so gasoline prices have stayed quite low, petrol prices. So I think that's one reason. And the other one reason is there's no increase in unemployment, right? We saw today from the quits data, which is a little outdated, we saw a sort of slight drop in the number of jobs offered, but a drop in the number of layoffs. So firms are not laying people off yet, right? And I personally think this is the bigger issue, and why the Fed may have to hang out here much longer than we think.
3.6%, I think, is the expected number for Friday as well.
Yeah.
So we're recording this on, what day is it today? Tuesday, right? Tuesday.
Yeah. Tuesday, yeah.
And so we got
August.
Exactly. So we got those numbers coming out on Friday as well.
Yeah.
We'll see what that brings. But as you said, it doesn't look like a recession. If you look at it, I wrote down you need weaker GDP, but no, we're growing, right? 2.4% and higher unemployment. No, it's actually came down last month.
You know, I don't want to get overly complicated with people, but it goes back to, I think there's a very simple relationship that's going on here, Kai, and let me do a couple of steps to it. So the first thing is to go back to that idea of hyper-financialization. If equity prices in particular lead the real economy, the equity market has been robust. If you look at the correlations between the equity market and the employment market, jobs, very, very high. If you look at the correlation between the employment market in broad terms and what we refer to as nominal GDP, so inflation plus real growth, they're very, very high. So what does this basically mean? I think this means the longer that equities continue to remain robust and rally, the more robust the labor market remains, because CEOs don't feel the pressure to lay people off. And in fact, Kai, if you look at layoffs, they peaked, right? We all had, beginning of the year, remember, we had tons of headlines about tech sector laying people off. Why? Because tech stocks dropped in the last half of last year, right? In the second half of last year. Since then, they've rallied. And what has layoffs done? Steadily declined. Steadily declined. So, robust equity market, robust labor market in broad terms. That leaves you with robust nominal GDP, okay? So nominal GDP on a year-on-year basis is probably running at around 6.5%. That is miles above equilibrium, right? Equilibrium, even assuming we're growing at trend, and remember the Fed has talked about a period of sub-trend growth, equilibrium would be 1.75 real GDP, okay? 2% inflation. Okay, so 3.75 nominal GDP. We're growing at 3% above that, right? So here's the problem. The problem is that we have this narrative now, and you just talked about it, that growth is reaccelerating, and it has reaccelerated, right? So inflation's fall, but nominal GDP stays the same. So what happens is your inflation falls, your real growth must accelerate, right? If nominal is still 6.5 or 6.75 and inflation, let's take an extreme example, inflation drops to 0, then your real growth must accelerate to 6.5, 6.75. Now, the bulls would say that's nirvana, woohoo, right? You know, no inflation, Fed's done, real growth, off we go. The problem is typically recovering from a slowdown. We don't have 3.6% unemployment. We have typically 6% unemployment or 8% unemployment. And that, I think, is extraordinarily problematic for the Fed. And I think really questions to me this kind of nirvana that the recession happened last year. We had 2 quarters of negative GDP. It wasn't technically a recession, but the recession happened last year. Inflation is dead. Real growth can accelerate. I just think is very, very naive, and I think he's very dangerous. And that's why I say at bare minimum, the Fed ain't cutting and may have to hike again, depending on this equity market.
Well, next FOMC meetings in 50 days, 81.5% right now say no change.
Right.
And 18.5% actually say hike. So there's no cut debate yet. That hasn't come up yet. So really, really interesting. Like, we got lots of big topics still to tackle here, Julian.
Yeah.
I want to just circle back to inflation real quick, because I drew a Christmas tree here on my little piece of paper here, because that's what the inflation chart reminds me of a little bit, and the transitory discussion we've had before. But it's not about the transitory discussion. It's more about, okay, inflation coming down too quickly and actually hitting the bottom out of the barrel here, right? If that makes sense. Just looking at the chart, is it coming down too fast? Like,
no. I mean, typically, if you look at historically inflation, it kind of looks like a mountain range, right? It very sharp peaks, drops, materially, and then kind of bases, and then we have to see what sort of happens. And the reason for that is because you get these very sharp base effects, right? So actually, I think we were talking before we got on air. If you look in Europe, all the improvement in July was energy prices, right? That was all the improvement. Everything else still stayed at 5+%. So what we have going on here is we have, and to a certain extent here in the US too, we have a very, very large. We're catching the tail end of the benefits of falling oil and commodity prices. And will that persist? Well, we're going to start to see in the next couple of months. The base effects start to drop out. Where we go from there will depend to a large extent on the strength of the underlying economy, what the dollar is doing. But this idea, Kai, that inflation is defeated, it is vanquished, we are going back into deflation, simply does not pass the smell test. If you look at one of Jay Powell's favorite metrics, which is service inflation, right? He talks about this, and I think he does it politically because actually it's highly correlated to the labor market, and it gives him a way of being hawkish without saying, I'm being hawkish to break the back of the labor market, which is politically unacceptable. But if you look at service inflation, if you look at, I'm just trying to pull the numbers up here. Okay, so service inflation ex shelter, which is his favorite, okay, is now 3.2% year over year. Okay, service inflation ex energy is 6.2% year over year. So what has driven that 3% divergence? Energy prices. And the base effects of energy start dropping out next month, right? Remember, inflation is a year over year metric. So anything that was older than a year ago disappears. And I suspect what we're going to find in September and October is that we're going to find that some of these miraculously disinflationary effects could start to drop out. And historically, it hasn't been unusual when you look at that service inflation, those two metrics, to see the service CPI ex shelter, bounce back to where this X energy is. So imagine, you know, in October, I'm not saying it's going to happen. I don't think it'll go quite that far. That if Powell's favorite metric is no longer 3.2%, but 5.2%, the world's going to feel very, very different then, Kai.
Yeah. Well, Brent is at $85 a barrel again, right? And crude is at 81. So we are seeing an uptick here. So that could push us a little higher.
Yeah,
I want to get away from the inflation debate a little bit because I wanted to cover two more topics, which is bond market real quick and the US dollar before we talk commodities. And we're already at the 30-minute mark here. Bond market, briefly talked about it before coming on air here as well. The US has to issue a ton of treasury bills and new bonds. We don't have an exact number. I tried to do some math based on some really rudimentary newspaper articles, and I think Wolf Street put something out. I think that's a blog. I'm looking at least $1.5 trillion that will have to be issued.
It's monumental, right? I mean, a lot of that's rollover, but there is new issuance of somewhere between 600 and a trillion, to your point, of net new issuance. It's an enormous amount of money that has to be financed. And it's not only here in the US, everyone's running big debt loads, right? So this, I think, is a structural problem that the world has to face. This is why I'm a structural bond bear. I believe that bond yields structurally rise for the next 20 to 30 years. And I think it's a huge problem for the Western world. Right here, right now, I think the debate is to go back to what I said earlier. If equities do not give up the ghost, if they continue to push higher, remain resilient, okay, and I do question that short term. I think they look extended, as I said before, but if they do not, and central banks try and pretend that they are done, there is a risk that we will see long-term yields push higher, Kai, because the bond market has given these central banks an enormous degree of credibility. If you look at long-dated interest rates, don't want to get too complicated, but there are bonds, you know, called break-evens that kind of measure the market's expectation of where inflation is. And you look across most countries, they're expecting central banks to win and inflation to come back to the targets, 2%, around 2%, whatever, right? But if central banks are perceived to be going soft, right, for whatever reason, that they either aren't willing or are unable to deliver the rate hikes to truly crush inflation, or they are thinking that maybe they'll move the target from 2 to 3 or 2.5 or whatever the hell it is, then these long-term bond yields have to start to adjust, Kai. And we're actually seeing some pressure there. It may be a concession into, we get the announcement of what Treasury is going to do in terms of funding tomorrow. So it may just be an adjustment ahead of that. So we have to kind of wait and see. But if these longer-term yields keep pushing higher, I think that's going to be a problem. And the one actually to watch is not 10s in the US, it's actually 30s. 30s are pushing out to new highs on a closing basis and could be in for a 30 basis point move, which in long-term yields is a lot.
It's 4.1% right now for the 30.
Yeah, so. And they could easily go back up to the highs of 4.4, 4.3, something like that. So I think if not higher, we're technically, when we look at it, we're wondering if it could even go up to 4.5, right? So I think this is a very, very interesting point. It goes back to what I said. If stocks don't adjust, bonds have to adjust unless the central banks are really forceful and say, I'm going to do what's necessary to get this equity market down, to weaken the labor market, to weaken the underlying economy. And they're not saying that. Like the RBA was supposed to hike this morning and they didn't. Mm-hmm. And immediately the long end of these bond markets started to kind of wobble a little bit. Whoa, wait a second. You promised us, right? This is why we still own this stuff. So I think that's really what's going on there.
Yeah, fantastic. I think we're working our way up the totem pole here a little bit. Let's talk US dollar, because ever since the Fed came out with their statement, no recession, the US dollar sort of bounced off the 100, or the Dixie bounced off, sorry. The 100 level, we're 102 now. Decent move, actually, for that indicator.
Decent move. Look, I'm very much in the camp that the dollar is vulnerable. Okay, I think if you look at the the bigger picture, we've frequently seen in history periods where money gets sucked into the United States. It creates this kind of virtuous cycle between rising asset prices, money flowing in, a booming economy, which needs to be funded by foreign inflows. We saw it particularly heading into the dot-com bubble. We saw it over in 08, 09. We've seen it again today. So I think all the world's money's here. I think it's all unhedged. It has to be to fund our current account deficit, and it's all invested in very expensive US assets. So does that unstable, stable equilibrium unravel, Kai? And the answer is maybe. We've seen some cracks, right? European stocks actually had been outperforming the US in euro terms. You would have been better off being long euro stocks than the S&P since the beginning of Q4 of last year. So that was kind of the first warning sign. We was getting worried about a slowdown. That was another warning sign. And, we got a little bit of a wobble on the dollar, but now all of those things have reversed a little bit. So I think there's two metrics which I watch. The first one is, and this is, the two levels, which I watch. When it comes to the euro, the two levels you have to watch are 110.80 and I think it's 104.34. I think those are the numbers. Correct me if I'm wrong, but they're basically the highs and the lows that we saw on a closing basis in the first 3 months.
I'm just looking at the chart. It looks like that. Yeah.
Yeah, first 3 months of the year. So 80% of the time, the high or low of the year is created in the euro in the first 3 months, which means if we get a close above that level, 110.80, okay, then you can get the odds are 80% the trend in the euro is up. If it's below 104 and check whatever it was, then the trend is down. And we got so close in the middle of last year. It looked like we were getting the breakup, and it came back down for the end of the month, so we didn't get the close. So it's a monthly close above those levels, and that, which to me will dictate. And maybe we need to see a bit of dollar strength if it looks like the Fed isn't done, right? If this data keeps strong. So I think that's where we are. But structurally, I think all the money is here, and I think that means that the US dollar is structurally vulnerable. Broken, not yet.
Well, at the end of the month, we have a meeting coming up in Johannesburg. I don't want to get too much into geopolitics. What's the interview I've done with Simon Hunt recently? Yeah. I think it was a fantastic conversation. But the dollar seems to be under attack a little bit. The de-dollarization term keeps floating around.
I agree. I think it's I with all deference to some of the previous speakers, I think it's not, and we've seen actually comments to this end from some of the BRICS, most notably in the Indian central bank governor, right? It's not as easy as you would think to set up an alternative. Doesn't mean that we're not going to see an incremental step. I suspect we are, Kai. And there's no question that, the dollar's hegemony is being challenged. But I would caution some of your more avid enthusiasts for the precious metal to say, look, are we really going to dethrone the euro? Are we really, the Western world, really going to hold its wealth in gold, particularly if it's backed by the renminbi, which is the currency of a communist totalitarian state? And the answer is no.
No, that's a question asked as well. Like, if you're a really hardcore believer in gold and gold bug, you need to transfer your currency or your money into a gold-backed renminbi if you're serious in what you're doing, right?
Yeah.
So, true to your thesis. So, I know that's a little far out there. I don't want to go down that rabbit hole, but I do want to talk commodities and what is influencing gold price, especially today. A bit of a heavy red day on the market. Gold only down 1%. Silver's being beaten up here, 2.4% down. Of course, dollar strength I think plays into that. But let's analyze.
And I think bond yields, right? I mean, if you go back and you look at a chart of silver in particular, silver is just like a super high beta anti-dollar trade. I mean, it's literally the high on silver, or the low on silver was 2002, right? It was the high on the dollar. And the high on silver at 50 was 2011, low on the dollar, right? I mean, that's what it is, right? I mean, don't get me wrong, I'll be long it if I think the dollar is truly broken. Got to see the price action first, and it isn't there yet, right?
The tape doesn't tell us that story yet. That's
Yeah,
true.
correct.
So but it's range bound. So I'm surprised actually personally, and I've said that in other conversations as well. Gold is hanging in there at
Yeah,
1940.
I mean, it's not.
So
They're not. Yeah, it's look. We know there's some strong hands in there, right? There's no question. Central banks and reserve manager demand, and it's, you know, I think it's trading well, as you said, given what else is going on. Does it mean you want to buy it yet? Not yet. And I think you've got to be a little careful that, you know, I'm sure there's a number of your listeners, and I'm not saying this is the case, but let's say we had a, you know, I do think there are elements of the US equity market that look highly bubblicious. Okay. Let's say we had a equity market crash tomorrow, right? I think you've got to be careful and say, do we, in that environment, does silver go up or does gold go up? They might outperform, Kai, but it doesn't mean they go up. They just may go down less than equities. And I think that's something at this stage of the cycle, you've got to be a little careful. Typically, they will really go up once the Fed goes, oops, slash, 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 and the dollar really turns, because they are, and all commodities are something that benefits from reflation. And that's what dollar weakness creates. Dollar, it's like the crack cocaine of the reflation trade.
Crack cocaine. It reminds me of the movie I watched recently, The Cocaine Bear. So hilarious. Hilarious. We got to talk base metals real quick because we had the recession discussion. Where do you see base metals, copper obviously in particular, heading? We're about to break $4, it looked like, until today.
I think it's too early, right? I mean, I think it's, you know, you can't, if we don't think central banks have done enough yet, you know, and growth, there are growth problems, manufacturing in particular, right? This is the sensitive sector for base metals, right? Until we see an uptick and a material uptick in something like ISM manufacturing, or, you know, some of the Asian PMIs, and we're seeing a little basing, but it isn't, I don't think it's enough yet, Kai. And I would want base metals to precious metals to go first, then I'd start to load up on some of these things. So I just don't think you're there yet, sir.
Do you have any more details on Chinese what do you call it, like subsidies for their own domestic economy?
No,
like,
it's not really my area of expertise.
No, because I haven't read much about it yet, like in terms of numbers. So I was just wondering if you had some more details. Fantastic. Julian, I think we're through the list of topics I had prepared. Student loan debt is maybe the last one, but then I caught a new article just this morning that Biden put out a new program. So I'm not fully up to speed, but it just sounds like it's almost half now, and some people don't have to pay it back, or it's being. It's a difficult topic.
This is part of the problem, right? I think, you know, the administration and the Fed are truly at odds. The Fed is trying to engineer a slowdown, and meanwhile, the Biden administration is. Because they've got an election to win in 2024, Kai. We know that's all that matters here in the US.
Exactly. But that's how he suckered them in the first time, didn't he? So, fool me once, I thought. So, I don't know. And I'm the German observer here, right? So.
No, and I think, look, I'm the British observer, you know, but, you know, I think that's why, you know, if this keeps going, if they keep spending, if they don't allow the slowdown to happen, the bond market is going to has to do the adjustment, because they're not done.
Absolutely. Julian, fantastic conversation. I'm going to give you a chance to toot your own horn a little bit and talk about your conference at the end of September as well.
Yeah. So we're holding a conference. It's our first macro conference. We've sort of, you know, I've been to lots of these things over time. I'm going to a precious metal one in Zurich in I think it's November. You know, so and I appear at these things all the time, but you know, the ones that have really proved useful for me are ones where you get something concrete out of it, because a lot of smart people come along and they talk about things, but I'm like, okay, well, now show me the money. And the whole thing with MI2 is we do try and make concrete trade suggestions and ideas. So we're really sort of splitting this conference into things that we think are structurally important as we move into 2024 and beyond. And then have a bunch of people who can help people make money, not only just from a trade perspective, Kai, but also from a portfolio allocation perspective. So I've got some friends who I really think are very good at, and they're registered investment advisors. So they do this for a living, at talking about how to allocate portfolios and the structures they can look at and so on and so forth. So there's that, and it's going to be in Vail in Colorado in 26th to the 29th of September. It's the most beautiful time of the year to go.
I've been there. The
most beautiful time of the year. It is definitely one of those ones that if you don't take your wife, partner, whatever, she will hate you when you bring back the pictures. So you should. There's going to be a ton for them to do while they're there. It'll be one where you could actually indulge your inner geek, which is what we all are, right? Yeah. And win brownie points. And you don't get many of those, Kai. So yeah, so if you go to our website, mi2partners.com, you'll see the sign up on the top. I still think you can get a discount if you sign up. And look, if you don't want to do that, follow me on Twitter at mi2partners.com. Or if you're interested in the institutional stuff, reach out to support@mi2partners.com.
Fantastic. You also have a great newsletter, by the way. So
yes, thank you very much. Yeah, sign up for that. That's a freebie.
Fantastic. People like freebies. So.
Yeah, they do.
Fantastic. Julian, fantastic conversation. Really, really appreciate your time. Lots we discussed. And to everybody else, thank you so much for tuning in. We hope you enjoyed this conversation. I definitely did. I knew I was looking forward to this one for a reason. And Julian's put me right here. So it was fantastic. Make sure to sign up to the channel because I know 80 to 85% of you watching are not subscribed for whatever reason. Let's change that so we can bring guests like Julian back on the program, maybe more regularly as well. Love hearing from you as well. Leave a comment. What do you think is going to happen? Are we all trying to be smarter than the Fed? Is the Fed whacking us over the head? You tell us. Put that in the comments. Want to hear from you. Let's discuss. Really, really appreciate your time. Thanks so much for tuning in. We'll be back with more.